Good morning, Sense of Things family. It's Jeff and Ron here, and another week. Lots of crazy economic data and a lot of things going on in the market. So we're going to kick off. We're going to actually suspend our something fun this week and just get right into it. Ron, how you doing, bud?
Morning, Jeffy. Yeah, we could spend 2 hours doing this, but people would fall asleep by the 45th minute.
Yeah, no
A
kidding.
lot of good economic news.
I don't know about good economic news, but a lot of economic news. Let's just go with that.
A lot of good conversation news. How about that?
So what's going on out in the world of Arizona this week?
I know that actually, I thought this was interesting. This came out a couple of months ago, and I know it's been in the headlines talking about bringing manufacturing back. Arizona has been, for whatever reason, identified, targeted as a great place to build these semiconductor plants.
Interesting.
Now, I think it's Taiwan Semiconductor or Intel halted their plan or paused it because they said they can't get enough skilled workers.
Interesting.
So
with Arizona State University right there.
You know what? I tell a lot of people this, why'd you move to Arizona and whatever? There's a lot of reasons, but of the top 6 most populous metro areas, right? You know who they are: New York, LA, Chicago. Houston's number 4, Phoenix is number 5, Philly used to be number 3, now they're number 6. Phoenix is number 5. Over the last 3+ years, Phoenix is the only one to have population growth.
Wow.
As far as metro area and whatever.
Yeah.
So this is a great area. Obviously, people are moving here, a lot of California. People are moving out of California to either Arizona or Texas. But look, this is a great place, just standard of living, everything else. Housing is still reasonably priced depending on where you're looking, but they can't get enough skilled workers. You got to be kidding me.
Yeah, which is crazy. Or you'd think they'd be able to ship in enough skilled workers at that point, because this is not like we're paying people 20 grand a year. A semiconductor manufacturing person gets paid pretty damn good.
Yeah. And depending on who you talk to, they said it takes 3 to 5 years to build a plant, semiconductor plant, because you got to think about the level of power, all the different maintenance they've got to put into the facility. 3 to 5 years. Hey, we need more semiconductors. All right, can you wait 3 to 5 years before we build a plant? So, and also, from what I understand, because I have a good friend and a client that was in a semiconductor industry for over 30 years, I had asked him, why can't they just ramp up production? He goes, those wafers looks like a big Frisbee. He said, do you know how long it takes to make one of those things? You know how long it takes to fabricate that and then to go in production? And I'm like, no. So you get a nice little education about what it really takes for these semiconductor plants to get online and to manufacture and to, it doesn't happen quickly. And look, we have all the best technology in the world and we can't shorten the manufacturing. I think it's interesting.
Well, and I think if I remember correctly, about 2 years ago too, the silicate that they use to fabricate those things largely comes from China. And they had like a massive fire at one of their plants, I think a couple years ago. And that's a large reason what was the downstream effect on when we were having problems with vehicles getting chips and things like that. It was all upstream from there in the raw material part. Yeah. So it's interesting how still as we try and decouple a little bit from the manufacturing side of, okay, let's move out of Taiwan and move it onshore here to the United States, we still are screwed, because if China is the one that's manufacturing the silicate and everything else that needs to be done, and they're having supply problems, we could still be in the same boat.
Look, not to talk about all the geopolitical headwinds that could be in front of us, but we all know about China and Taiwan. And look, Taiwan Semiconductor is the largest semiconductor company in the world.
Yep.
They're not stupid, and neither is the United States to know, hey, you got to build more plants here. Because if China decides to just completely circle the island, how much do you think is going to get to Europe and to us for our manufacturing? That'll go down to a slow trickle or get seized up. Yeah. I don't think China's that stupid, but I think we've seen stranger things happen in the last couple of years.
Oh, I think I just see more and more underpinnings of the Chinese economy really massively slowing. They've got an aging. I was watching a thing the other day, and this guy was talking about the population of China, because they had the one-child policy for so long.
Right.
Now it's like there's not On one end of it, they don't have the young people enough because they had the one child policy. And then all of a sudden they've got a ton of old people on the barbell on the other side of it, and production slowing, everything's slowing for them. And they fake the numbers as it is, and they're not even able to fake them as much anymore.
I think one of the bigger problems in China right now is, it's funny, you correlate the one child policy with China, right? In the United States, quick right turn, then back. So in the United States, many builders that are building, let's say, a 50 house development will build a few spec houses, right? Because they want to just show people what it looks like and then eventually just sell them. China has this one child policy, but they forget about speculation housing. They've been building speculation towns, now called ghost towns, all over the country. Nobody's living there, right? So if you think about it, if you're building these ghost towns, right, to eventually populate them at some point, and you have a one-child policy, how are you supposed to populate them? So now all those builders are on the brink of, if not already in bankruptcy, and China's been trying to build them, bail them out. It just doesn't make any sense. Who knows what shoe's going to drop there? But remember, last week I showed the chart comparing our markets to the European markets to the Chinese markets. The Chinese markets are doing worse than the bottom of 2020 COVID low. What is that telling us?
But I mean, if you look back over the last 20 years, everybody talked about China and how great it's going to be and the BRICS and all this. If you look at the performance of China by itself, it has been absolutely atrocious over the last 20 years. It's not been that tiger economy going. It's been this horrid, you basically lost money over the last 20 years having money invested in it, in comparison to even the worst of the European markets have done better than China in those cases. So it's
just amazing if you think about it, because of all the build out and all their technology and everything else. And it doesn't make any sense, but I think it's starting to make some sense.
It is. And I heard an interesting interview yesterday with the assistant prime minister of Italy, who was in New York, and they were talking a lot about about their economy in general in Italy and things like that. And he was talking very, in depth about the China Belt and Road Initiative, which, for people that don't know what that is really China's way of rebuilding the Silk Road effectively. So they've been trying to build these little connections with African countries, and they've been trying to get their foot into Italy and some of the European countries. And Italy, the previous administration to this one, which was very left-leaning, they just went all in with China, and there's a lot of promises on the Chinese side, and the delivery has not nearly been as much, because there's this promise of, if you'll let us kind of trade with you, then we'll take in imports and things like that. And they pull the same thing that they pull with us. And Italy's, I think that I heard him say, he goes, we took in all this stuff that they wanted to sell us, and we got to sell them tomatoes. That was it. From the
Italy that sit on the dock and spoil before they actually pass inspection.
Exactly correct. It's one of those things where it's okay, they've been trying to use that to get resources in Africa and everything else. We'll come in and build roads for you as long as you sell us your resources, so your people can go dig in the dirt or be underground in these mines doing all this. We get it for super cheap, but we'll put roads into your country for you. And that's really been the whole Belt and Road Initiative. And this is Xi Jinping's biggest, it's what he feels like he can use to take over the world, but it's just not working, because people are starting to see behind the curtain and go, I see how this is good for you. I don't necessarily see how good it is for me.
Talking geopolitically with all that stuff. I don't know how we're partnering with any of these countries, because they all want to see us off the map.
I do agree with that. It's a never-ending thing here. Well, let me share my screen here real quick, and I will. Okay, can you see that?
Absolutely. MBA mortgage apps.
MBA mortgage apps. So last week I was talking to one of my good friends who's been in the mortgage industry for 40 years. And he was like, we have had this week, when I talked to him the day before that, he said that we had the lowest amount of mortgage applications ever in his 40-year history. Whammo! This week goes off the charts the other way, up 5%, up 2 2.3%. Refis are up. This is a very
How are
volatile
refis
number.
up?
Huh?
Are people at 10% mortgages? They're
I
refinancing?
guess. I think when we had a few years ago, we had a few like 6 months ago where we were much higher in the mortgages. So I guess people are refining. I don't know.
The highest rate in 30 years or whatever it's been. How are people refinancing?
I don't get it. I don't get it. I mean, probably it might be people
They still have
refining.
mortgages for 1981. Is that what it is?
Yeah, either that or they're refining out of 5-year floating rates or something like that at this point.
Oh my gosh.
The only thing I can think of. But yeah, just sometimes what a difference a week makes. Keeping on the housing market side, housing starts and permits. Starts were down, but I guess the good part is the permits are up. When we look at this for August, yeah, we're not starting as many as had been expected, the consensus, and we're way below consensus range, but the permits were there. So that means that at least stuff is coming online at this point. Existing home sales, and this from talking to my realtor friends is right on the money. They were in there in the range. Year over year, though, is down. Existing home sales are down about 15%. I'm seeing, like in my neighborhood, which is typically one that if a house comes up, it's gone. I'm seeing houses for sale in my neighborhood now for 6-7 months now. When prices are coming down, my friend Richard, we do another podcast together about Austin, and he was telling me, I guess there was a house in his neighborhood that he sold last year for $605,000, like a 4-bedroom house. A very comparable house this year is selling for almost $100,000 less, which is, it's finally coming back to some reality at this point, because people were just holding out. They were keeping their prices too high. So I think it's very likely, at least here in Austin, with the froth that we saw over the last couple of years, that we might see home prices starting to come back into reason a little bit.
Yeah, but a 17 to an 18% decline in 1 year?
Yep. Crazy. This is another one of, we talked about this a couple weeks ago on the show, of some of these really squidgy numbers that are coming out of the government. And here's jobless claims, just came in this morning at 8:30 a.m. Consensus estimates were 225. We came in at 201 and down 20,000 initial claims. I'm sorry, I don't buy this one. I have a feeling this one's going to be one of those that miraculously gets adjusted somewhere a few months down the road, because this is no way. We've got all this stuff going on with UAW and all that. That's probably going to increase this pretty significantly.
Yeah, but the furloughs, they didn't furlough. I don't think the furloughs and the retrenchment was as high. Look, if this continues to go on, it'll definitely go up.
Oh, yeah. Yeah, because it's going to affect more than just the big three. It's going to affect all the downstream folks, all the people that make parts for them and everything else, and the other companies. This was interesting, and this is staying on trend for what we've seen over this year when it comes to the manufacturing indexes. So you've got multiple of these throughout the different feds, and the manufacturing index, the Philly Fed, has been bad this year, but it was really bad. And this is somewhat of a forward-looking index in a lot of cases. And
I talk about being out of consensus range.
Yeah. It's like consensus was 0.5 and this thing came in at -13. So I have a feeling that when we start to see the Empire State one and all that, you're going to continue to see more of this trend of these guys looking at, okay, things don't look good looking out into the future.
That's where the retrenchment will happen, is in manufacturing.
Yep. Yeah. And you'll start seeing the layoffs in the manufacturing side, is my guess at this point. All right, so LEI, we talked about it a little bit a few weeks ago. Today was the LEI number for August, continued down. If I were a chartist, which I am, and I look at this chart, if you look at every time in history where this chart's been down, that typically means we're in a recession. And this time, we're not in a recession, but I just have a sense that we actually are already in a recession. Now, the only thing that's holding it off, and it's not fully indicating it, is that GDP has been popping up. But once again, I'm not convinced that the GDP number is a solid number at this point, because they keep revising it every time. They'll come up with the final number and then they revise backward. You said what, last week they were revising back to 2008 at this point.
Yeah, 15 years later.
Yeah, amazing. What's affecting it? I changed down 0.38 again. It was down like 0.25 last month. So it's continuing to get uglier. There's only a couple of categories that actually are positive. Most of them are negative. The non-financial components are, I think the biggest ones are the consumer expectations of business conditions are way down. The index of new orders continues to be down. And some of these other ones that have been positive are starting to peel into the negative. And as Ron's talked about before, that 10-year spread, less Fed funds, boom, it continues to get worse and worse as we go.
Yeah, look, we're an echo chamber here almost every week, but seeing these things, how do you ignore facts?
It is. And you look at, this is the final chart really off the LEI page, the recession signal, it's signaling that we're in a recession. It is, can't be flashing it much more at this point. And it's intriguing to me that typically we see that spike down and then the spike back up, we see the recession actually indicated, and we've turned up a little bit. Although this one is a little deceiving, because if you look at the other chart, it's not nearly as positive as this would appear that it is, or the upward moving as this one would appear. But once again, I think it's telling us, I just have that feeling that we're going to start seeing more and more of this going forward, where we start to roll into the back half of the year. We're going to see the consumer really stretched at this point with all the stuff that's out there going into this holiday season. I think it's going to be interesting. And I think it could really put us at that point of true recession, especially from the consumer, if they're not powering the economy like we've been seeing.
Let me segue on that, two things.
Yep.
So number one, I don't know who's doing these surveys or whatever, but they already did a survey about the Christmas and holiday shopping season that people are expected to spend less. They've already got a survey out. People already expecting to spend less. And this just came out this past week. Second, after the Fed announced multiple things yesterday. One, obviously rates didn't change, but they're probably going to raise in November, which we thought it was either going to be September or November. Yep. Even after that, higher rates for longer, which I'll start showing in a second. Bank of America came out and raised their price target on the S&P. for the end of the year to 4,600, I think, from 44. And they said, and when they started to bring up a lot of the factors we talked about and other things, price of oil, all that's baked into the market. Oh my God, you gotta be kidding me. You gotta be kidding me. It's just brutal. All right, here, let's move it along here. Let me know when you see my screen.
It looks like it's coming. There we go.
All right. So I'm not crazy about this chart. Jerome Powell's even come out and said he's not crazy about it. But basically, folks, what this is saying, without doing analysis by paralysis by analysis, is that basically what they're saying is they're looking at one more rate hike. And then by the second half of next year, they reduced their forecast of potentially 4 or 5 rate reductions to 2.
Okay.
The second half of next year. And then if you look, then it really goes down in 2025 and in 2026. But they announced higher for longer, and it's going to take a long time. Of course, no timeline there, but a long time to get down to the 2%. I'm figuring 3 to 4 years.
Yeah.
We've been talking about this for a while. But the reason why I have something in the upper left-hand corner of the screen, and I yanked, this is just a headline on an article. We've been talking about this on and off for many months. All these freaking idiot pundits keep coming out. They got to lower rates. What the Fed is really saying is, shut up.
The Fed is saying,
listen to what he's
very
saying.
clear.
If you think about it, over the last 20 years, right? We've had Greenspan, we had Bernanke, we had Yellen, and we now have Powell.
Yeah.
Now, there's always that infamous new language everybody needs to learn called Fed speak, like they're speaking in tongues.
Yeah.
Like you got to digest it. You got to read into it. If you think about it, right? Stop. sift through all the cloud, right? Get to the fire. This is what he's saying, folks, right? He's been saying this in almost every meeting for the last year. And when they interview the other Fed committee members, they're all saying higher for longer. Mm-hmm. Why are you saying, no, don't listen to that? What they're real, stop it. Stop. Guys, people, live with it. Adjust your portfolios accordingly. If you're a business owner, you better get prepared if you're not already. Just stop it. Stop looking at all the fringe BS and listening to all the people pitching their book. The Fed is saying higher for longer. All right, let's move on. All right. So just some other slides here. I will get this off of CNN. I know you pulled this off a few times on some podcasts. Market momentum is at a greed level. I think we realize that because it's not jiving with everything else. So think about this. Look at the divergence here. Market momentum is at greed, but stock price strength is at fear. Stock price breadth is at fear. Mm-hmm. What is that telling us? It's those top 8 stocks, folks.
Yep.
Right? That's still an agreed level as far as I'm concerned. Right? Mm-hmm. We got some M&A going on today with Cisco buying Splunk. We've had some moderately successful IPOs in the last week, which is always encouraging. Yeah. But if you take a look at the IPOs that have come out in the last 18 months, I think more than 80%, I don't know the exact number, 80 to 90% are all below their IPO price.
And even the 2 that came out that were moderately successful are starting to roll over a little bit. ARM and
Instacart, yeah.
I mean, Instacart,
they just pulled their pullback. It's pulling back with the market too, right?
Yeah.
People are peeling off their profits and saying, moving it into something else. Mm-hmm. So the next one, so you got the safe haven trade is at a fear level, but mm-hmm. Here's my favorite one. The junk bond demand is at an extreme greed. Why is that an extreme greed? Because they're getting yields at 6 to 8+%. Mm-hmm. Why wouldn't they go in? Is the risk, of course, but that's why there's junk bond funds, right? You spread mm-hmm. out your risk. You're still getting a high yield, but that's a great place to go for a portion of the portfolio because why? You're going to get great yield. And when rates go back down, the asset values are going to go up. Just like any other bond, just like preferred stocks, you got that seesaw effect between yields and asset prices. So junk bond demand is at an extreme greed because money is flowing out of equities and into junk bonds for the yield and for future capital appreciation.
It's the highest performer in our momentum trading portfolio that we run this month.
And by the way, the junk bond funds will probably a great place to be for the next 24 months.
Yeah.
Especially, we just talked about it. The Fed talked about 2 potential rate cuts mm-hmm. next year. If we get pauses for several consecutive meetings, and we know and then of course it's going to affect the economy and the markets, and then we get a rate decline, the first rate decline, you're going to see spikes in the junk bond funds.
Yep.
You have to.
Yep.
So it'll be interesting. Yeah. All right. I got one more slide, and I know we talked about this in our pregame. I'm going to bring it up, and I'm going to let you do the play-by-play because it takes me 10 minutes to say hello and 20 minutes to say goodbye. I'm speechless. Can you explain this, Jeff? Please go over it first, and then I'll add some color because I don't get it.
I think what all Feds, I'm completely convinced all Feds are just issued a dartboard. And they just throw a dart at a dartboard and come up with a number because I have no answer for this. Now, the one thing I will say, and we talked about this before, the St. Louis Fed, I think, has been the most accurate on their forecasts. I never listen to Atlanta because they're just morons. And New York's not much better. But St. Louis Fed's actually been pretty damn accurate when it comes to their forecast. And I personally think they're pretty much right on the money at this point. And you figure what's not in there, probably, I don't know when these all came out, what's probably not in there is the impact of the UAW strike on all of that, the trickle-down effect of the UAW strike across the board, because it's not just, oh, okay, it's GM, Ford, and whatever the hell they call Chrysler today. It's affecting all the manufacturers that make parts for them and all the companies, even the companies that make the paint that they put on the vehicles and everything else. It's affecting that all the way across the board. And I think it's going to have a pretty pronounced effect on Q3 GDP.
This is what I don't understand. They all have access to the same information. Yep. How does the Atlanta Fed show strong economy, strong growth, and we're trending upward? And then you get another Fed saying, nope, this is probably the first of 2 consecutive quarters of negative GDP growth.
Yeah.
We have they're showing contraction. Mm-hmm. How is the diversity here of over 5 basis point difference?
And St. Louis Fed, if you believe what they're saying, which I tend to follow along there, and you look at the leading economic indicators, it's actually probably pretty damn right that we're actually we see a negative, and we start to see the beginnings of a recession at that point. It'll still be a look back no matter what. The LEI is what's telling us ahead of time, but it doesn't get filled in as a true recession until you have those 2 negative quarters. Yeah. Although last time we had 2 negative quarters, the federal government went, that's not necessarily true.
I like I said, I'm speechless. I don't get this.
Yeah.
But here's the fun thing. Here's the fun thing. When the GDP number does come out next month for Q3,
yeah,
I can't wait to see what the excuses are going to be on one side or the other, because forget about the New York Fed's in the middle. Let's just say they're in the middle.
Yeah.
But let's just say it comes in at 3%.
Okay.
What is St. Louis's Fed's excuse? And what is the Atlanta Fed's excuse for being so far under or so far over?
Yeah.
And let's say it's at 1%, right? It's closer. Who would the Atlanta Fed? How should any of those people keep their job?
Or why should we even listen to them at that point? What's the point of you putting out such horrendous research and predictions? What's the point? I just don't get it. Once again, as we've said before, the things I would love to come back as an economist or a stock analyst, because I can be wrong 50% of the time or more and still keep my job. It's awesome.
I know. I said that last week. Don't forget about a meteorologist.
Well, that's true. Yeah, meteorologist. I don't look so good on TV, so I couldn't do that. And
come on, you and I got faces for podcasts. That's why we're here.
I know. Yeah, because we're little small things on the podcast or whatever. But yeah, it flabbergasts me to see some of these. And we see it on the economic data as well, where they'll have these consensus ranges that are 4 or 5 points either way, and they still miss it. That's what I just think is hilarious.
Like I said, we'll have to see where it is next month. We'll have a fun podcast with that. We'll re-show the forecast
we'll have to
versus
save
the
this
actual.
And go back. Yeah. When they show GDP, save this and go back and say, okay, guys.
I think there may be a report behind this, but how do you throw out a number without any substantiation of how you got there? I don't know. Maybe got to look this up for a report. It's probably an exercise in futility, but I'm curious to see how both ends here came up with their numbers. I don't know if we're going to have a contraction, but I can't see a 4.9%
growth rate.
Print.
Yeah.
Maybe it's more towards the New York Fed number, but I can't see 4.9.
And the other part is GDP in Q3 is typically like the worst one of the year. So you're not going to tell me that we're going to completely dispense with all history and say that, oh, this quarter was just amazing this time. So,
well, we'll see. We'll have some more fun next month, I guess, with it.
Hilarious. Unbelievable to me. What else you got?
Nope, that's it. That was the last one. I had to end on a high note here.
Of course, yes. You had to end on a God only knows where they were trying to go with this thing. So, folks, as per usual, there's some head scratchers in this. I think more and more things that I'm seeing are pointing to, all right, things are slowing. And especially on like I said, what I've been watching really carefully is that manufacturing index across the board. And every one of them, Richmond, Empire State, Philly, has been negative most of the year, even though the predictions have been that they were going to be positive. That tells me that those guys are pulling back, and that may be what's affecting the ISM inside the leading economic indicators, because if those manufacturers are going, yeah, I don't know what's going to hit me coming up to the end of the year, I'm not really going to be putting out a lot of orders for raw materials or parts.
Yep, and the manufacturing is definitely a canary in the coal mine for economic expansion or contraction. That's for sure.
Absolutely. Cool. Folks, as always, we do these for you. Make sure that you hit that subscribe button wherever you're watching this at, which should be mostly on YouTube, and give us an up thumb to say, hey, we're out here. If you have enough guts, give us a comment. Let us know what you think of some of this, and let us know if you have any questions. So as always, we do these every week on Thursdays. So make sure that you are subscribed so that you'll get every single one that we put out. And a special announcement to those of us, or to those of you that are watching and follow us, I have a special episode that I recorded earlier this week that I'm going to drop as well this week. That is with a friend of mine who's an expert in the college loan reduction programs that are out there. We went through that. We talked a little bit about the challenges of the student loan debt issues and some ways that you could potentially solve those. So I encourage you, make sure you subscribe when that one hits. So that's said, we'll see you guys back here the very next time.